All right. Well, welcome back, everyone, to the TEN13 Co-Pilot series. Today, I'm joined by my good friend, Don. Don, welcome.
Pleasure to be here.
Awesome. So, Don, you've had a really interesting career, and I'd love to sort of chat a bit about that. So, you've gone from a trader to like a CTO to a developer, and now a startup founder at Aerofiler. Maybe talk us through sort of like some of the formative parts of your early career that kind of led you to where you are today as a founder.
Yeah, sounds good. So I sort of went to uni early 2000s. Claim to fame was I was sort of a year behind Scott Farquhar. So Scott Farquhar was my tutor at uni. So started off, in a pure tech capacity. After graduating, I went into stock market surveillance. So we wrote kind of algorithms to detect insider trading. Software sold to ASIC, all the major investment banks, and from there I gravitated toward the algorithmic trading side because I figured there was kind of more money to be made, yeah, sort of on the trading than the compliance side. Fast forward a while, that went reasonably well. I was happy how that kind of portion of the career went, and then just through personal dispute that my family was having, that led me to law because the lawyers weren't solving the problems that we were bringing up with them, and so I ended up, I think looking back, kind of foolish decision that worked out well, doing a law degree essentially to resolve that myself. So with 1 year of law school, that's contracts and civil procedure. We sort of went to court, got the decision in our favor, which is good. Ended up falling in love with the law, which I didn't expect. I thought it'd just be a short-term thing. So I went to practice law. The study of law I found was a lot more interesting than the practice of law. Practice of law was, well, essentially that's partly what led to Aerofile. A lot of manual work, form filling, that sort of thing. And so at the time I thought, well, it's not. I think that the thing that really crystallized what I wanted to do was when a partner said, I was 10 years to get the partner, 2 years interesting work, 8 years of manual labor. So I thought, hey, why don't we try and look at just compressing, solving, removing that 8 years of manual work. And then so I got together with a few of the, going full circle, a few of the people I went to uni with, and co-founded Aerofiler, which is a legal tech startup.
Yeah, amazing. Tell us about Aerofiler. What are you trying to solve there?
So it's the contracting problem for in-house legal teams. So at the moment, a lot of the tech stack for lawyers, they're progressing a bit more, but it's still shared folders, spreadsheets, Outlook, a lot of manual work. So it's a classic SaaS play, I guess, where we're trying to digitize that, remove friction points, and streamline each part of the contracting process from drafting all the way through to filing, managing obligations.
Got it. And so fast forward to today, you've got this successful startup. How did you find time or the bandwidth to sort of get it into angel investing? Can you talk us through how you got involved with that?
Yeah, so the first few investments I made, I guess, were from people I knew, my network. So I did all the due diligence myself, and then in terms of bandwidth, I mean the capacity I had to manage deal pipeline very low. So I was just doing quite sporadic investments, and then when Aerofile went through the 10x program. That's how we connected, and I learned about the 1013 model, where 1013 will do the due diligence. It's a syndicated platform, and I thought that was a better fit sort of for where I was sort of trading off in terms of having some other people manage the deal flow, doing the due diligence. So now I guess essentially I've got capacity to look at sort of a much larger potential universe of deals.
Yeah, got it. And so do you remember your very first angel investment? Like what was the company, what time frame we're talking?
Yeah, company called Ditno. So basically it stands for data is the new oil. Clever little wordplay there. So it's a cybersecurity company, invested the early 2010s. I think that was just through a person I knew, and I did some consulting for the company as well, so I was familiar with what they did. But that's how I kick off the journey.
Got it. And so was it an investment that you made at the time because you really resonated with the founders and their vision, or did it fit into some overarching sort of strategy that you had at the time, or how did you get to a yes?
Yeah, partly, up until then, my investing was pretty, it was about kind of preservation of wealth, so just investing in property, index funds, things like that. And so I knew at the time I wanted to diversify into some assets with sort of a high risk profile, the potential for larger returns. So I guess a large part of what I was doing was just driven by a portfolio strategy to diversify. And like I said at the time, I didn't really have access when you're just starting out. If you don't have sort of a network, you don't really have access to any deal flow. So I guess the investment fit into more sort of a portfolio play rather than looking at a specific company. And that's how I kicked off the journey.
Got it. And what was the process like when you sort of made that investment from a DD point of view? Like, did you sort of dive into the tech stack and like you ended up doing some consulting? So did that sort of consulting work form the basis of your investment sort of thesis, or was it the other way around? You invested first and then started to work with them?
Yeah, I guess from a tech perspective, I was pretty familiar with it, so I knew that what they were trying to do was achievable. And then, from a DD perspective, they were trying to solve a particular problem in the cybersecurity space, and so I was, I just spoke to some people that I knew who were familiar with the space to see if there was sort of a gap there, what the need was, and essentially that was the basis of the DD. So if I thought the tech would work, if I thought qualitatively there was a need, that was enough for me to pull the trigger for the initial investment.
Yeah, got it. And is the company still around, or how has it gone since then?
Yeah, company's still around, so they're getting positive updates, sort of slow and steady growth. It's hasn't become the next Uber yet, but in terms of getting a return on investment, I mean, just a solid founder, who has basically been very resilient, kept the company going through a lot. You can imagine over the last 10 years, a lot of challenging times. So he's I guess it's good stewardship of the capital, and kind of happy with how it's going so far.
Yeah, makes sense. So just going back to when you first made your investment, it sounded like you were interested in diversifying into potentially higher reward, higher risk, potentially investments. Was there any other sort of notion of what success would look like for your angel investing portfolio at that time?
Well, I guess in the public markets, when I took on the more speculative stocks, you get a few what they call 10 baggers. So you'll invest and then at some point liquidate for a 10x return. And so at that time, I thought, if I invest in these companies and one of them, grows 10 times, at the time, I thought that would be a successful outcome.
Yeah, okay, got it. And so fast forward to today, so you've got a few more sort of, companies in the portfolio. Like, are you happy to share sort of, how many companies are in the portfolio at this stage, and maybe what sectors or industries you're currently, I guess, heavily invested in?
Yep. So at the moment, double digit portfolio. A lot of them have gone through 1013. In terms of sectors, I've got I guess part of my other background as well is just when I was doing all the stock market surveillance stuff, I was doing a PhD in finance as well at Sydney Uni. So didn't finish that degree, but that I guess so I guess the finance thinking informs a lot of what I do at the moment as well. So in terms of sectors, I look at it from a portfolio construction approach. So even if you've always got sectors du jour, the hot sectors of the day, like AI at the moment. However, I don't even when there's something that's there, I don't look to concentrate too heavily in one sector, because if sort of your financial history, you can go all the way back to kind of the nifty 50s back in the day, where there's 50 stocks that now they're not anywhere. Now you've got the Magnificent Seven of Google and Facebook, but I try not get caught up too much in any of that, and yes, look at things from a portfolio perspective, to not be too concentrated in any one area.
Yeah. And so how do you sort of operationally give effect to that? So do you have like certain caps in how much you can invest in a particular company or into a sector or industry, or how do you think about sort of not getting carried away and over investing into one area, for example?
Yeah, it's mainly, I guess, look at things on a deal by deal basis. So it's more like a lot of it's around I guess what I call bankroll management. So if you're, essentially, if you, with the first investment I made, I probably put quite a bit more in than I would now. And once you realize it's a marathon, not a sprint, you construct. I guess if you have a look at it, if you're looking at a traditional fund, for example, you might have, let's say your 20. If I'm going all the way back, your 2012 vintage, your 2013, your 2014. And so if you have a look at it and think, okay, I'm investing in 10-year cycles here, if I want to have a little bit in every year, what does it look like from on a year by year basis going 10 years forwards? I think that in a large sense provides a lot of protection. It's a little bit like dollar cost averaging. If you've got a strategy where you can consistently put in money between now over the next decade, it's going to be pretty hard to be too heavily invested in any one area if you maintain your discipline.
So do you have like a dollar hard cap for each year? If you think about vintages in that way, you're like, hey, I have a target allocation for this year into this particular asset class being angel investing, or is it more case by case driven still?
Yeah, I guess I've got a baseline strategy to say, well, if let's say this is the model, if you will, if this is my strategy to invest over the next X years, this is how much I can put in with this frequency. And then occasionally, if something comes in that looks really good and you want to do a follow-on round, that will there's some flexibility to do that, keeping in mind that that will potentially diminish the ability to invest in future rounds. But I guess if you have rules for what the follow-on size could be, you can still work. You have some flexibility there, but enough discipline so that you're not kind of just putting all your money in one vintage and then potentially not getting it sort of averaging out your risk over time.
Sure. Just want to double click on the follow-on sort of conversation. So you know, a lot of the rhetoric in venture investing is like, you know, follow your winners and continue to support them. Like, do you have a framework or a way of thinking about that? Do you allocate sort of certain part of your angel investing portfolio to follow-ons as opposed to new investments, or?
I think it makes sense from the perspective of if if you kind of knew which ones were going to do really well, then yeah, it makes sense to follow on. But I guess what I've found looking at the data is the survival rate from round to round is actually, I think it was roughly the same. So I might be a little bit off. My understanding is from, let's say, C to Series A, the drop off is 80%, A to B, 80%, B to C, 80%, C to D, 80%. And if that's the case, then I've sort of done the math on it. The follow up doesn't really, it basically you can't kind of predict what's going to do better. Then following on makes less sense. So I guess that's how I think about things. If you really knew the ones that are going to do well, like if you knew what the next can would be, of course you'd bet the proverbial house on it. But so that's sort of the question that I'm still grappling with. It's a sense of, well, when the next round comes up, do I have a better sense than can I beat the averages basically? Like if the drop off rate's going to be 80%, can I do better than that? And if so, it makes sense to invest more. If not, then then I wouldn't.
Got it. So then is there a tendency then to just reserve the dry powder for just new investments into new companies, and then more of a case by case into follow-ons if you feel confident that, you can beat the odds, so to speak? Or is that how you think about it? Or?
Yeah, that's, I guess, over time, that's how I look at it now. So in the case when you're investing in equity markets, I think concentration, I'm sort of been a Warren Buffett follower for a long time. So concentration makes a lot of sense if you can have conviction on a particular stock where there's so much information, a long history. In startup land, I think the opposite is the right approach the more I look into it. So because at the early stage, it's hard to really say with any conviction which ones are going to do well out of the whole, universe that you're investing in. I think diversification makes sense. So that's the side I'm erring towards, just a sort of a larger number of smaller diversified investments rather than betting too much conviction on one particular startup.
Makes sense. Has anything else about your angel investing strategy or approach changed over time, Don? Whether it's like thematics or themes or sectors over time, or have you kind of stayed true to just what you started with?
I think so. So when I started with, there was, I guess the major shift is to essentially have a way to manage pipelines. So when I started, I thought, well, I'll just individually speak to founders, do the due diligence, go through, and if that's the sort of strategy you have, then it makes sense to put in kind of larger investments for each startup. But then over time, I've realized, individually it's hard to get, unless you're very well connected, it's hard to get access to good deal flow. So I think one, it makes sense to go through funds or syndicates who are connected like TEN13, and then over time, because the deal flow increases, the universe of investable startup increase, then I guess the strategy is morphed to just having a more disciplined approach for each startup in terms of amounts of investment, frequency.
Got it. Makes sense. So given now you've tended to partner with funds or syndicates like you say, what does your DD process look like today now that you're not sort of speaking to as many sort of companies one-on-one? Like how do you supplement the research and DD that's being done by some of these partners, or what does that process look like to you?
Yeah, so I guess the good thing about your partnering is if the syndicate like TEN13 can do sort of the heavy lifting DD at the sort of founder level, the tech level, what I've found really makes a difference is, I guess the thing to get right is the size of the opportunity. So if you do kind of some rough math, so if you've got, let's say, a portfolio of 10 companies and you've won a 20% internal rate over, let's say 10 years, as it turns out, if nine die, to keep nine don't make it, to keep the math simple, the one that works, you need to sort of go 60 times to get that 20% internal return over 10 years, and with dilution and so forth, you might be looking at 100x returns. So I think the thing that will make or break a strategy is whether the winner is going to get to kind of 100x mark or more. And for that, I do supplement sort of the DD that someone like TEN13 will do with independent reports from others world. So I just cross-check the size of the market and so forth. And real thing is and the competitors, so you want to know that if they win, they'll win big. That's kind of what will make or break the strategy.
So when you're doing your own research or you're meeting companies directly, like what do you want to assess when you meet a founding team? Is it more technical capability, or is it their grit or resilience, or some combination of the above? Or what are you hoping to see when you meet founders?
Yeah, it's an interesting one, and I found that in terms of predictive ability of the founders, it's a tough one. So this is not kind of maybe in line with what everyone else does. But if I bring up a specific example, I know that someone else operating in our space, for example, they have a huge kind of distribution network with access to sort of 10,000 potential customers on a mailing list. And when they launch their product, you know, they're getting really good traction off the gate. And if I was doing DD about that, there's nothing in particular about the founders in terms of their background, their skill sets, their knowledge that kind of has led to that. Initially, it's the case of just the distribution network, which other founders might not have. So founders who might be better on paper might not be as successful for that reason. And so I guess the way I look at it, traction kind of smooths a lot of things out. Like it doesn't matter, sort of degrees or educational background or network. Like if you can get to, a particular revenue milestone within a period of time, take into account, whether the motion is an e-commerce play or B2B or B2C. I think the ones who do well there, that's what I look for in the ones who have done that, whether it's, even if it's good fortune, even if you just happen to know someone at a Fortune 500 company and that's rocketed you off to to initial success. I think that's a pretty good, that's a better indicator than degree or network or working history in terms of what the future will look like.
Yeah, makes sense. Is there a pet peeve that sort of is an immediate deal breaker for you when you meet founders, or?
I guess if they're not forthright, I guess if there's a difference sort of between what they say and what the DD comes out, that's an issue. So that's something I carry over from traditional investing. You want a good management team. You want them to be upfront. You want them to be, I guess, honest when things are not going well. You don't want them to sort of try and smooth over the warts. And so it's not necessarily a deal breaker, but it's certainly a red flag if because all the investors know it's a high risk investment. We don't need to sort of be buttered over. It's just better to be truthful on both sides, so that we both sides go in essentially with the right expectations for the relationship.
Eyes wide open and right expectations. Yeah, makes sense. How are you thinking about AI, Don? It's talked about and written about so much, but where do you see value in AI? And are you actively investing around that thematic, or are you trying to sit aside given all the hype and rhetoric about it?
It's an interesting area. So the way I see it is, I read an interesting post kind of over the weekend, someone working at OpenAI, and they just said, well, I guess the starting point, I think there was an internal paper from Google saying nobody has any moat because open source is going to come at everyone's lunch. So from a technical point of view, as interesting as a technology like ChatGPT is, it's based on a model called the Transformer, which everyone knows about. I think over time there's not going to be a competitive edge from a tech front. Similarly with, I was reading someone in OpenAI said train a lot of models and essentially the results just converge to what the data looks like. So the technical aspects are the same depending how you train it. That influences what the model will look like. So I guess one, proprietary data sources, I think that'll be an interesting source of competitive advantage. But going forward, it probably might have already happened, but going forward, AI will look a little bit like, an Amazon server or an Azure server, where it's undifferentiated heavy lifting. It's the ones who can build something interesting over the top of it, make it more user friendly. So it's, I guess that's how I see AI. If I had to boil it down, it's a little bit like an Amazon server. Over time, everyone's going to have one. It's not going to be a source of competitive advantage. It's kind of how you leverage that.
It's more of like a building block upon which you can build an application specific use case and so forth.
Yeah, so I think companies who do that will potentially have a competitive advantage, but it's going to be a pretty thin moat. So anyone who says AI is a moat anymore, that I'd look at with a healthy dose of skepticism. I think it's sort of an interesting tool that can be used in different ways, but I think everyone's going to have access to the same tech before too long.
Yeah, got it. How are you guys leveraging sort of AI within Aerofiler? Well, I assume you are, but
I guess in the contract space, lots of interesting use cases, everything from drafting to reviewing contracts. And so we started primarily as a sort of contract repository to store, extract, analyze data, and that's where we're focusing AI at the moment. So in an investment context, for example, someone gets a term sheet in, they might be interested in a whole bunch of things like drag along rights, tag along rights. Traditionally, as a lawyer, you'd have to sit there with a spreadsheet, read the documents beginning to end, type them all in, get them reviewed. So we're essentially looking at automating that extraction piece as the first cab off the rank.
Yeah, got it. No, it seems like a lot of low-hanging fruit there for sure. And so just going back to angel investing, like what's the best pitch that you've seen recently, or the best set of founding team members that got you to a yes? Like what was it about them that sort of set them apart that got you to invest?
I think it's probably going a while back, and during the peak, Trienta had a really, I guess, impressive, in terms of traction. I think one of the fastest growing companies that a lot of people had seen, and so something like that is impressive, where you can see even with a company like Facebook that didn't have monetization strategy for a long time, like just fast traction is kind of what really grabs my eye. I guess Mr. Yum's another one who they just grow explosive growth out of the blocks. So when I see companies like that, when I see companies that have just incredible they've got month-to-month growth that for any other company would be good from a year-on-year growth perspective, that really catches the eye. So there are a few there where it's certainly not kind of a slam dunk in the sense that every startup's got a challenge to solve, but I think if you can kind of grow that fast early, you've got a lot of good, if it's in your DNA, you've got a lot of good building blocks in place, and then once you solve the other problems, things will follow through. So if people have a stunning product, for example, but if you've only got a couple of customers, then kind of then back in my mind, gee, you could solve kind of a product which is already a really hard problem, but then you've got to if it's not going to get out there, it's not going to be distributed enough, there's still going to be massive problems. Whereas if you're fast, especially if you're fast, it's almost, especially if you've got a bad product, it almost makes it better, because you're fast growing with a mediocre product. And
totally.
When it all patches up.
So in some respects, the I guess the proofs in the traction and the execution. But then how does a very early stage company sort of catch your attention? Like, they haven't sort of launched a product even, for example, or do you just not invest at that sort of super early stage?
It becomes a lot harder. So you'd really need, I guess, a company that I know about that would be kind of interesting in that regard is one called Morse Micro, where they're building something that literally I don't think anyone else has or can be doing. So high level summary, not that I'm invested in Morse Micro, by the way, but they're essentially building, as I understand, long range kind of Wi-Fi, long range Wi-Fi. So if at an early stage company, it'd have to be deep tech, something like that, or quantum computing. If it was sort of an early stage SaaS play, especially with, and I guess that's the other area where kind of AI comes into it, that the barriers that they're just continually getting, the barriers to launching a product, they're continually getting lowered. So if it's, sort of, if I look at something and I think, and in the back of my mind, I think, gosh, could you do an early prototype in a week kind of thing? That it's harder, I think, to get me interested at an early stage, because even if they pull everything off, but the distribution, the problem solve, you've got competitors coming in, and so once you raise to a certain dollar value, it's proof that you've solved some of those problems. But if it's an early stage SaaS play, with no kind of traction in terms of users or revenue, they're ones that
harder to get excited about. Yeah, it makes sense. And how have you thought about sort of geographical sort of diversification over time, or is that something that features into your mind? You mentioned some international companies like Trienta. Is that like a deliberate part of your investment strategy in the angel investing space, or is it more case by case once again?
I think it is a deliberate. It's sort of a deliberate part of my thinking, in the sense that one of the things you learn the first thing you learn in finance is they've got this thing called an efficient market theory, which says that all stocks are perfectly priced all the time. Second thing you learn if you do any trading is you realize it's complete rubbish. Like, there's no such thing as a perfectly priced market. So in companies, in regions like the US, yes, you've got companies like OpenAI that can grow explosively, but at the same time, if you're doing seed rounds at raising $10 million at a $40 million valuation, that's pretty efficiently priced. Like, it's hard to really squeeze a lot of good gains out of there. So if I look at other geographies like Latin America, like Africa, my thesis is that there'll be more, from a pricing perspective, the markets will be less efficient there. There'll be opportunities to do rounds at a much lower val than what maybe US, Australia, Europe will have. And then at the end of the day, that's what's going to get to your 100x return, right? Because if you sit down and do the math, massive difference between a 10x return and 100x. I mean, self-evidently, yes, but if you break it down into internal rates of return, there's a difference between breaking even over 10 years, in which case you're really backwards after inflation, versus something like a 20% return, in which case, very, very on your way to building meaningful amounts of wealth.
Yeah, got it. And so if we cast our mind sort of 10 years forward, Don, and we think about your angel investing portfolio, like, what would be the markers of success? Is it really just financial sort of gains, cash on cash returns, or is there some other sort of factor that you want to point to as being a successful endeavor for you in your angel investing activities? Or
I think for the main reason I get into it, and I imagine most people get into it, is kind of cash on cash returns. So anything, if you look at successful private equity funds, anything that doubles cash over 10 years, I think that's up until recently was the target. Anything better than that will be a good outcome. And I guess along the way, if there's a chance to kind of participate in some way. So I guess the good thing about TEN13 is there's a network there. There's the opportunity to meet people, to liaise with founders. It would be, I guess, the cherry on the cake to be able to, at least add in areas where I've got domain expertise. If I can help founders in some way, I guess whether or not I'm directly invested in that, that would be nice, because part of the reason I got out of trading was financially lucrative, but I thought, gosh, fast forward 50, 60 years, is this what I want my legacy to be? Algorithmic trading, just writing robots to take money off robots that were a little bit less efficient. That's not really where I want to be. So from an angel, I mean, cash on cash is head and shoulders number one, but certainly not my primary motive overall in life. I can help. I'd very much love to do that as well.
Awesome. Well, that's been great, Don. Thanks for your time today. What's if we just leave one question, like what's something that you're working on that or involved in life that gets you excited?
So I guess, I mean, AFSL just takes up the sort of the overwhelming majority of my time, and so what we're kind of trying to crack, that would be good. One, if we get it to a state we're happy with. The idea, with open language or with large language models, everyone's going through the idea of prompt engineering at the moment. They're saying, well, if you just kind of write the right prompt in, you can get it to do anything, which is true. But in the real world, we've found that quite difficult. So one thing we're trying to do is just get large language models working in the background without any prompting. So essentially, we're just building an interface where you want to do something, you just point and click, highlight a few things, and then you can scale that across all your documents. So getting some good early results, and then over time, if we get into a good enough level of accuracy across a wide enough range of documents, that's something we'd really try to check off and say good piece of work done on our side.
Amazing. So if I'm an organization or a company and I'm interested in sort of learning about Airfile, like where can I find out more?
Airfile.com. It's got a booking link to our calendar list. So happy to for people to just jump on, book a meeting. We can have a chat and explore how Airfile can potentially help.
Awesome. All right. Well, thank you so much for your time, Don. It's been a great conversation. I'm sure there's going to be a lot of takeaways from that. But thank you again.
Thanks, Great chatting as always.
All right. See you. Bye-bye.